Welcome to Talk Tickers, your necessary shortcut to understanding the critical takeaways from corporate earnings calls. Today, we are strapping in for a deep dive into the Q3 2025 results and the subsequent management commentary from Airbnb.
Yeah, and if you watch the market reaction after the call, you know the narrative that really won the day. It's this story of, well, confident execution, accelerating core bookings, and a pretty clear multi-year growth strategy taking shape.
Right. Management's message seemed really strong enough that it kind of overshadowed a slight miss on the bottom line, didn't it?
It really did. This call was definitely all about momentum and, I'd say, optionality for the future.
Okay, let's start with that result snapshot then, because the financial picture was, as you said, a bit nuanced. On the revenue side, things looked pretty robust.
Yeah, they had a top-line beat, came in at $4.1 billion.
Which was what, about 10% year-over-year growth?
Exactly, 10% up year over year, and just slightly ahead of the consensus estimate of $4.08 billion, so solid.
And critically, the underlying growth engine. Sounds like it's not just running, it's like speeding up.
It is, yeah. Gross booking value, or GBV, surged 14% year over year. That's up to $22.9 billion.
14% is a strong number.
It is. And if you look at the raw volume, nights and seats booked grew 9%. That actually shows a sequential acceleration from Q2.
Ah, okay. So demand is actually strengthening in their key markets.
Seems that way.
That said, we do have to address the GAAP EPS. That clocked in at $2.21.
Right.
Which did miss the street consensus of about $2.31. Now, normally, seeing an EPS miss like that, it spooks the market. But here, it didn't seem to. Why not?
Well, this is a perfect example of, financial noise versus the operational reality. That EPS miss, it was mostly driven by a non-recurring item.
Okay.
They took a one-time $213 million valuation allowance.
Okay, simplify that, Fred.
Think of it like this. They're cleaning up the accounting books today by taking a big one-time hit. But doing that paves the way for a much lower effective tax rate every year starting in 2026.
Okay. So it's related to that new tax bill, the One Big Beautiful Bill Act.
Exactly. Management was pretty clear. Short-term accounting pain, maybe, but for a significant long-term structural tax benefit down the road.
Got it. So if you kind of ignore that accounting one-off and look at the operational efficiency, the picture changes quite a bit.
Dramatically. Adjusted EBITDA was $2.1 billion. That represents an incredible 50% margin.
50%. Is that a record?
It is the highest margin they have ever achieved in any single quarter.
Wow, okay.
And, a 50% adjusted EBITDA margin paired with $1.3 billion in free cash flow in the quarter. That just proves their core business is, well, highly optimized and throws off a ton of cash.
Even while they're investing heavily elsewhere.
Exactly, even while they're pouring capital into those future growth levers.
Okay, let's unpack those strategic levers now. Management focused on, 4 key areas driving growth.
Yeah, 4 main things. Improving the core service, aggressive international expansion, broadening their offerings with new products, and deep AI integration.
And which one is really the engine of today's growth? What's driving things now?
Oh, hands down, it's international expansion. This is the segment that really validates the whole growth story right now. Management stated that their expansion markets, places like Japan, India, Brazil, they're growing at approximately double the rate of their core, more mature markets.
Double the rate. Wow. That's significant.
It really is.
And those results seem to be validating their localization efforts. You mentioned first-time bookers.
Yeah, first-time bookers were up over 20% in Japan and nearly 50% in India. That shows they're successfully finding brand new customers in these key areas.
And they gave that great example about payments in Brazil, right?
They did. The introduction of interest-free installment options there, it now accounts for nearly half of the booking value in that specific market.
Just shows how critical understanding local payment habits is.
Absolutely. That's how you win in these hyper-local markets. But, they aren't neglecting the core experience either. They highlighted a commitment to high-velocity product development. Announced 65 major platform improvements just since May.
65 improvements in, 4 months? That is moving incredibly fast.
It is. Real speed.
Did management give any sort of evidence that all this tinkering is actually driving bookings, or is it just features for feature's sake?
No, they pointed to a couple of things. First, the introduction of Reserve Now, Pay Later in the U.S.
Mm-hmm.
They said that was instrumental in the sequential acceleration of nights booked in North America.
Okay. And people are actually using it.
Massively. They reported a 70% take rate among eligible customers.
70%.
Yeah. And management seems confident that the immediate booking lift they're seeing easily outweighs any, modest increase in cancellations that might come with it.
That makes sense. I also noticed the details on user experience improvements, specifically those advanced map features showing landmarks, public transit, satellite views. That sounds like a small thing, but for someone booking travel, how much does that really move the needle?
Well, it's a classic example of removing friction, right? Before, you'd find a listing you liked, then immediately jump out of the app to Google Maps to see where it really was.
Yeah, I do that all the time.
Exactly. And maybe you get distracted or forget to go back and book. By layering in those external map views directly, they keep you inside their conversion funnel.
Ah, okay. So it's kind of a smart defensive play to increase the odds you book right then and there.
Precisely. Keep the user engaged on their platform.
Okay. Now let's pivot to the longer game, what they call the multi-year build section. This includes things like services and experiences and that hotel pilot. Management was very clear here. This stuff is going to take time.
Absolutely explicit about it. They said this will be a 3 to 5 year journey to become a material part of the overall business.
3 to 5 years.
And it's an entrepreneurial approach. City by city pilots, starting in high density places like Paris and Los Angeles.
Why the slow, methodical, city by city rollout? Why not just flip a switch globally if they think it's a good idea?
It really comes down to risk management and making sure the quality is right.
Yeah.
Their core product, homes, it's non-standardized, right? Every listing is unique.
True.
So they can't really afford to scale a bad product or a bad experience globally. By testing in one city, they learn how to train hosts properly, they figure out the regulatory issues, they prove the economic model before committing massive resources everywhere.
Okay, that makes sense. Control the variables first.
Exactly. The good news, though, is that the quality they're seeing in these pilots is already high, averaging about 4.3 stars for experiences.
And it seems to be broadening their appeal, too.
Definitely. They mentioned that nearly half of the people booking an experience did not book an associated stay with it.
Oh, interesting. So it's attracting completely new users to the platform, not just add-ons for existing home bookers.
That's the takeaway. It's widening the funnel.
And is supply keeping up? Are hosts interested in offering these things?
Seems like it. The supply side is definitely responding. They received over 110,000 host applications just for services and experiences in Q3 alone.
110,000.
How's that compare? That's nearly double the previous quarter. So the appetite from hosts is clearly there. The scaling just needs, well, patience.
Patience also seems required for the hotel pilot. That's being tested in supply-constrained markets like LA, New York, Madrid.
Right.
Is this them trying to compete head-on with Booking.com or Expedia? Or is it something else?
They frame it more as supply augmentation, not direct competition displacement. They aren't trying to replace their core homes business.
So filling gaps.
Exactly. Plugging use cases where homes might be less suitable. Think like one-night stays, last-minute business travel, or maybe in cities with really strict short-term rental rules.
Right.
And their argument is pretty compelling. They already have billions of users coming to the platform looking for accommodation. So layering in some curated hotel supply is actually much more capital and time efficient than building out their original home supply network was from scratch.
They leverage the existing demand. Makes sense. Okay, let's move to the future. The huge investment in AI, management made a strong case for why their business, with its unique, non-SKU-based listings, is kind of uniquely positioned to benefit from specialized AI.
Yeah, they really believe they can win the travel search war through specialization, not generalization. And their initial results in customer support seem to back this up. They said smarter AI has reduced the need for human agent contact by 15% in their U.S. pilot.
15% reduction, that's immediate, measurable cost savings right there.
Absolutely. Bottom line impact.
And the future vision for AI sounds incredibly ambitious. They're testing AI-powered conversational search, moving towards what their CEO called a what box.
Exactly, that what box concept. It sounds like moving away from just typing keywords in a traditional search bar.
Like 3-bedroom near Paris.
Right. Moving towards a true concierge service across the entire app, something you could use next year.
So you could ask it something much more complex.
Yeah, like, I want to take my family of 4 to France, but my son is really into Roman history and we only have 5 days. What should we do?
And the AI would plan the whole thing. Stay, experiences, everything.
That's the vision. Curate the entire itinerary based on that conversational request.
Wow. But maybe the most compelling philosophical point of the whole call was the CEO's macro vision. He framed betting on Airbnb as fundamentally a bet on AI. That seems counterintuitive.
It does at first, but his argument was fascinating. He argued that as the digital world becomes increasingly saturated with AI-generated content, fake images, synthetic articles, deep fakes.
Right, the artificial stuff.
The basic human desire for real-world connections, for authentic experiences, for actual reality will only increase.
So their platform, which facilitates real experiences.
Exactly, is therefore uniquely positioned to capitalize on that massive macro shift away from the artificial and towards the authentic. It's a really interesting inversion of the typical AI narrative.
It is. Okay, turning back to the financials for a moment. Capital allocation. With all that cash being generated, what are they actually doing with it?
Well, Q3 free cash flow was robust, $1.3 billion. And trailing 12 months FCF hit $4.5 billion. That's an incredible 38% margin over the last year.
Huge numbers. So buybacks, dividends.
They're being disciplined capital allocators, primarily focused on returning cash to shareholders via buybacks right now. The company repurchased $857 million of common stock just in Q3.
And cumulatively.
Since starting the repurchase program back in 2022, they've actually reduced their fully diluted share count by a substantial 8%.
8% reduction is pretty significant. Okay, looking ahead, Q4 guidance, what did they signal?
Q4 revenue guidance is set between $2.66 billion and $2.72 billion.
So it implies about 7% to 10% year-over-year growth. Still decent.
Decent, yes. However, they did anticipate that nights and seats booked growth will moderate a bit, down into the mid-single-digit range for Q4.
Mid-single digits, is that a red flag? Slowing growth.
Not necessarily presented as one. They cited really tough year-over-year comparisons from a massive acceleration they saw last year in Q4.
Ah, the comp issue.
Right. And maybe more importantly, despite that anticipated bookings moderation and the fact they're dedicating around $200 million this year to invest in those new services and experiences.
They still raised margin guidance.
They did. They actually raised their full-year adjusted EBITDA margin guidance to approximately 35%. That's up from their previous floor of 34.5%.
Okay, raising margin guidance even with heavy investment, that's a key signal of operational confidence, right?
Absolutely. Shows they believe they can walk and chew gum at the same time, invest for the future without breaking the highly profitable core business.
Good point. And to wrap up the strategic context, management really pushed back forcefully against this idea that the core homes business is like mature or plateauing.
They did, very strongly.
What data did they use to make that argument? How big do they think the opportunity still is?
Well, they used a simple, powerful stat. For every one person staying in an Airbnb on a given night, about 9 stay in a traditional hotel.
9 to 1. Okay.
That massive market share gap suggests to them that the core business still has huge headroom to grow, especially if they can continue to solve issues around quality perception, price discovery, and filling supply gaps in certain areas.
So they're looking at the entire travel market, not just the alternative accommodation slice.
Exactly. They view the whole pie as their addressable market.
And that ties into their renewed innovation model, right? This sort of entrepreneurial approach where they test things, like their high-end luxe segment, via city-by-city pilots before scaling.
Yeah, it seems like a major shift in how they operate, moving away from maybe a slower, more linear product development cycle and adopting this rapid, small-scale testing mentality. It lets them manage risk better, get immediate data on product market fit, kick the tires before committing billions in capital globally.
Makes sense to de-risk those big bets. We should touch quickly on a future roadmap stuff, too. Loyalty programs and advertising are always topics that come up. Where do those stand?
Still under consideration, definitely. But they're being very careful about the timing. For loyalty, they stressed it has to be unique and custom designed for their community. They won't just slap on a generic points program.
Right, it needs to feel authentic to the brand.
Exactly. And they're deliberately holding back on rolling out a big advertising platform until this new AI-powered search paradigm is more firmly established.
Why wait on ads? Seems like found money.
Their thinking seems to be, why build an ad model around a search experience that's about to be fundamentally disrupted by AI anyway? Get the core AI search right first, then figure out how ads fit in.
Okay, logical sequencing. All right, it's time for our This Is Not Financial Advice segment. Based on this entire deep dive, it feels like the most critical element for investors right now is this divergence. You've got the successful immediate growth engines, primarily international.
Right, running hot.
And then you have these big multi-year strategic bets like services and hotels that will take time to pay off.
Yeah, it creates a really fascinating investment dynamic, doesn't it? You have that high confidence, already paying off international expansion growing at double the core rate. That's your immediate reward, your proof point today.
Right.
But that's offset, at least in terms of market perception, maybe by this aggressive multi-year investment cycle, remember, 3 to 5 years for new services and hotels to really become material contributors.
So the key tension for anyone looking at the stock is, do you trust sustained velocity of that international segment enough to ride out the potential short-term margin drag, or maybe just the perceived drag and the volatility caused by this heavy investment cycle?
Exactly. Our take, looking at all this, is that the underlying momentum, especially internationally, combined with that raised margin guidance despite the spending, it suggests confidence. The high cash flow generation gives them the firepower. So the outrageous but plausible trade idea here isn't super complex. It's really about positioning for a sustained grind higher.
So a long position.
Essentially, yeah. A bet that rewards investors who look past the near-term investment noise and focus on the operational execution. Banking on that international success, overriding the temporary margin concerns over the next, say, 6 to 12 months.
It's a bet on the operational acceleration continuing, not necessarily some clever financial engineering.
Precisely. Bet on the execution.
So there you have it. Airbnb's Q3, really defined by that accelerating core bookings momentum, and especially the international expansion story, paired with this real commitment to high-velocity product development across AI, payments, and these new offerings like boutique hotels.
Yeah, the cash generation remains just exceptional. And management did a really good job, I think, framing the company not just as a travel platform anymore, but as a disciplined growth story, one that's leveraging its unique position as a gateway to, quote, real-world experiences, especially in an increasingly digital world.
And that brings us to our final provocative thought for you, the listener. Management has positioned this company as a bet on AI, arguing that as digital content becomes more artificial, the demand for authentic, real-world connection will only increase. If that core thesis holds true, what untapped real-world service beyond homes and the current experiences might be a next multi-billion-dollar business that they decide to test first in just a single city pilot. Something to think about until the next deep dive.